Hello guys, welcome to the channel. I hope you all are doing good. Today we're gonna learn how we can create a company from scratch. So once you click on this button, then this window will be pop up, and this would be the place where you have to put your B1 site user password. And once you into that, and I forget mine. So once you into that, then you will see a new window which called the create company. And in this one you have to decide if this should be the trial version or the non-trial version. Then here you can give a meaningful name. I'm gonna do with the YouTube L with YTL, let's say. Okay, and I'm gonna say this will be the demo DB, right? And then you can decide from the localization, like from which country, because the different country have the different settings. And so I'm gonna pick Germany for here. And you can use the chart of account, which kind of chart of account you want. And you can select the language. I'm gonna pick the English, right? You have to define the posting period. So I'm gonna say that this would be 2021. The sub period would be yearly number of periods, and I'm saying like this would be unlocked for the whole year, right? And I'm gonna say okay. I will proceed, and then it will take a bit of time to process all the details before you're gonna see something else into the screen. And there are basically most of the things that we have to keep in mind while creating a company is like kind of chart of accounts, the items that you have to create into the system, the default master data that we have to prepare, and if there is any UDF needed for the customer, or and the different things that required from the user, from the depend on their basic need and what kind of company they are looking for, with the different setting, different chart of account, different master data, and so many other second settings that you have to keep in mind in the process of whole company creation. So you can see the running process in this status bar with this blue progress bar into the SAP Business One, and your control will be in the loading all the time because it takes a bit of time to preparing whole database and creation of the basic standard UDFs of SAP Business One and SAP Business One tables and the internal settings. That why is taking a bit of time to creating the SAP Business One company. And this progress bar is basically loading right now, and once it will be finished, then the company will be created and we can see the other settings that we have to determine in the as a first initialization of SAP Business One company. So once the company creation is done, then you will see this window pop up that you have to set up a kind of password, and it will give you the password example that you have to set up in here. So that should be contain at least one lowercase, one digits, and one non-alphanumeric character, right? So let's set up, right? So we just created a company right now, and we're gonna be logging into the company for the first time. Then we will go directly into the system initialization and the company detail. For the first time, when you will open it, will just get the company detail and idea and everything. The main bit, the main and important setting for the company is basically this one. This is like using the perpetual inventory or not, and this is the setting. This is the one of the few setting that is basically can be altered for the first time, and once you updated this one, then you cannot use it. right? And the difference between the perpetual inventory and non-perpetual inventory is basically the perpetual inventory is basically the inventory transaction affect both stock levels and values. So whenever you create any marketing document, for example, then it will then the perpetual inventory system reflect the value of inventory posting in terms of monetary transaction into the accounting system, right? So these are the transaction as carried out when the item defined as a inventory items and received or released from the stock of the warehouses, right? And in the perpetual inventory system, all the transaction, like especially the inventory transaction, affects both level and stock values. So that means the automatic journal entry will be get created, the stock value will be changed, and it's also created in the journal ledger, right? So the values of the last purchase price and the last price of the goods would be gonna be affected every time when you create any marketing document based on that values that you have entered the price and everything that would be that would be affect and creating the journal entry. And the other choice is basically here to not using the non-perpetual inventory system, and in which the sales, purchasing, inventory, and the production transaction will automatically create the inventory transaction, which affect only the inventory level but not only the stock value. So there will be no journal entry which will be automatically created, and there will be no automatic inventory related monetary entries into the general ledger. So it would be only affect the stock values, sorry, stock levels, like how much stocks you just sent to from one customer to another, or how much purchase order is committed, and all those values, but not anything regarding the accounting. So basically there, once you use the perpetual inventory, then you will see like there are different three kind of item group valuation method. And if you choose that, then you need to make the configuration setting during the basic initialization before posting any transaction. To activate this perpetual inventory, you just simply select this checkbox on the basic on this tab, right, in the company detail, and you can then set the default valuation method for your company, right? And this default will be used whenever you create a new item group. You can of course change the default in the item group for of any item assigned to the item group. And you also have the option to manage the item cost separately for each warehouse, right? So whenever you are creating an item, you can decide by yourself rather than setting the item cost at the company level. For sure, this can be useful when you operate into the several regions with the varying cost levels, right? So if you operating into the different systems, different regions, like in the US, Germany, and they have the different cost variation of the same goods, then you can control that thing by this. So once you have activated this perpetual inventory, then each transaction that receives or issue inventory item is reflected into the GL accounts. And after this, after the first inventory transaction posted, the option of choosing this would be disabled, and then status cannot be changed any time. So after once you have to decide it very carefully if you want to use the perpetual or not, because once you decided and once you make the first transaction into the system, then you cannot change it. If the customer needed to change it, then there is only one way to just recreate everything and recreating the whole company, right? So let's say, so for example, to describe it a bit more about these moving average, let's say a scenario. For example, whenever you created a GRPO in your using the perpetual inventory, right, and you purchase an inventory item, then the balance of the inventory account will be increased, right? And so when you sell this item and deliver it to the customer, then the balance inventory account will be decreased, right, by the same amount defined into the document, into the marketing document. So we will see the value increase as the stock quantity grows, and the value decreased as the stock quantity shrink, right? And the values of the item received into the inventory is based on either a purchase price or a fixed price. However, do we determine the value of the item when it is issued? the way we determine the item at sales is using by a valuation method, and these valuation method is called the moving average, standard, and the FIFO, which define the valuation method, right? So let's and so valuation methods are basically the formulas for how you determine the cost of units that you sell. So these formula control the inventory cost of an item if you use the perpetual inventory. And if you use the perpetual inventory, then you choose one of the three methods for any given item, right? So for example, I'm gonna say, okay, I'm saying we're gonna just use the standard one, and I'm using this one, and I'm gonna say manage item cost per warehouse. And now if I'm gonna go to the item master data, and if I wanna add any item master data, then you will see in here that I can change a valuation method for each item by yourself as well, right? And if you're using the perpetual inventory, then we have the three options to choose: the moving average, the standard, which called the standard cost, and the FIFO is basically known as first in first out. And an addition of the valuation method exists for the serial and batch managed item. The method is discussed as we will discuss is as like at the different video. So I'm not gonna cover this one in this video, and because we're gonna also have to learn about the serial number and batches for that before that. So we will learn that one first. So in this one, we only gonna be focused in these one. So moving average, FIFO, and a standard cost, right? So first we will see about the moving average, right? So when using this method, the system calculates the moving average price by dividing the total value of the goods by quantity in stock, right? So for example, let's say you have 5 items, right, for the price of 10 euro each, right? And so you have 5 items which would be equal to the 50 euro, right? Then the moving average price would be moving average price is 10, right? Because it is calculated by the dividing the total value, which is 50, and by the goods by 5. So 50 would be 50 by 5 equal to 10. So that would be my moving average for this month. And then you spend, let's say, 100 to buy another 5 at the price of 20, right? So you said I have now 10, another 100 euro. So buy 5 items, right? So you still have 5 items, but now you buy it for like 20 euro per each, and now it's called 100, right? Because you spend 100 euro on that. Then the total inventory value would be net worth of 150, right? Because we have 100 here and 50 here, right? So it would be 150, and which would be divided by 10, right? And then it would be 15 euro would be my moving average price, right? That would be my moving average price. So moving average price is used as the item cost when this item is sold or otherwise issued from the warehouse. So that's how the moving average price get calculated, right? Now for the FIFO method. For the FIFO method, the system calculate the item cost as the cost of oldest unit on hand, okay? The theory behind this valuation method is same as the name, first in and first out. So the first item received into the stock are the first items to be issued. So this is useful method if you have inventory item with the expiration date, right? So something like, for example, if you're selling breads or something in the bakery, in the big bakery, so that's the time when you will use the FIFO, or in the drugs, right? Like in the medication shop. So you want to sell those items before the expiration date, so you always sell the oldest item first, right? And how does this valuation method work is basically the system store each good receipt in the inventory in a separate layer, and when you post any good issue, such as when you sell an item, then the system use the price from the oldest layer, from the second oldest, from the third oldest, and as so on. And let us say, for example, that you buy a quantity of 5 at 10 each, right? 10 euro each. Then the unit cost of the first layer is 10, right? And you then buy a second quantity of 5, right? And at the 20 each, right? So your oldest cost remain 10 because we bought it by 10, right? However, you also now have a newer layer with the unit cost 20, right? Now the unit cost mine is 20 for each item. So when you sell the item, the system use the oldest layer first. So the first 5 quantity sold has been the item cost would be 10, right? And once those five item will be sold, then the item price will be automatically changed to 20 for next 5 items. And that's how FIFO work. Now, the last one is the standard cost, right? So when you select the standard cost option, you manually set a fixed inventory cost for the item. The system uses this fixed cost for all the stock movements in the SAP Business One. So this is basically logical method to use for the items which you produce in the warehouse, right? Which you have your own production for that, and you are producing that item, and then you can set your own price for each particular unit, right? So for example, if you set a standard cost at 10, therefore when an item is received into the stock, then it would be the valuation for 10 euro, right, for each unit. And when it is sold, then the item cost will remain 10. Then setting a standard cost is like making a royal decree. So you decide what the item is worth, and you specify the unit cost, and the item cost always equal the standard cost displays in the item master record, right? So once you set the standard cost, let's say 10, then the unit cost will remain 10. So each unit of the particular item would be 10. Then if you buy this item for 11, the difference of 1 would be posted to a variant account, and the item cost will remain 10. That is the basically the important thing that we have to remember. It is possible to adjust the standard item cost through the item cost inventory revaluation on the periodic basis. So for that, you can simply go here and into the transaction and use the inventory revaluation method. And from here you can for example of the standard cost might be a service, so you could have a service that you sell, for example the consulting, and the service is defined as the non-inventory item, so you can set the valuation method as a standard on that item on the inventory tab as we saw here, right? And then when you base the gross profit of the item, the base price of this non-inventory item is included in the calculation of gross profit for the service. So that's how the standard one is work. Let's see some other scenarios into the so now let's see some other scenarios, and this time we will see in the more detail. So for example, only have to remember, we're gonna talk about the moving average right now. So you have to remember the formula is that the moving average is that the item cost is calculated by dividing the total inventory value by on-hand quantity. So if we see a purchase of the 5 units, right, for 100 each, right, and then the inventory value at this point would be my 500, right, because it's like 5 multiplied by 100, so it would be 500. And then the moving average cost at this point would be 100, right, because the moving average would be 500 divided by 5, so it would be 100. And that is the inventory total value of 500 because as I said, 500 divided by 5. Then the second purchase is of made for the 5 unit, right? I'm again gonna say we purchase 5 unit for 200, all right, and each, and now this time it would be 1000. And now the total inventory would be inventory value would be 1500, because it would be so my total inventory value is now 1000 plus 500, right? This 1000 and this 500, so now it's become 1500, right? Now there is the quantity in the stock right now is 10, 5 units here and 5 units here, so that's 10. Now it is dividing by 15, which give us 150 item cost, right? And so Now this is my moving average for now, right? So now I'm gonna say, okay, we sell the 7 quantity. Now we're gonna sell the 7 quantity to the customer for like 300, right now. So the selling price is not important in the calculation cost. That's one of the things that you have to keep in your mind. And the cost of each item in the stock is right now 150 sale, right? So the item cost of each item in the stock at the time of sale is 150. So therefore the total cost of the sold good would be 7, right, multiplied by 150, which gives me 150, right? 1050. Then the inventory value is now 1500, right? This one minus the one 1050, which give me 450, right? And if you divide this by remaining quantity, which is 3, because we already sold uh, 7 quantity, then it will give you the 150 again as a unit cost, right? So you have seen that the moving average method is at the consequences in the sales and purchasing exercise, right? And this is how it's going to calculate it when you purchase and sell of the same items. All right, so now we will see the FIFO. So the FIFO method is like, let's say we already said FIFO is managed with the different layer, and whichever the first in, first out, and each inventory receipt transaction create a layer of the quantity linked to the cost, and each inventory release transaction uses quantities and their corresponding cost for from the first open layer. So in our example again, so let's say I'm purchasing the 5 unit for 10, right, by the GRPO, and create a FIFO layer with the 5 unit costing 100 each, right? So now right now it's costing 100 each, right? And we have the FIFO right now, so it is 100 each, right, for first layer. Now the total inventory right now for me is 500, right? The total inventory for now is the 500. Okay, then we have purchased a second quantity of 500 at 200, right? So I'm gonna say 5 unit for 200, and that would give me 1000. And the second good receipt PO would be the second FIFO layer of these 5 unit costing 200 each, right? So the 200 each for me right now, and the total inventory in this case would be so it would be my 200 first of all, and the inventory value is now, so now the inventory value would be my 100 1500 from like 1000 plus 500 minus 500 and plus 1000, right? So now if we say this would be my total inventory value, right? So this would be my inventory total inventory value right now. So I'm gonna say if I'm gonna sell the 7 quantity, right, for the sales price of 30, then remember the sales price is not important, as I told before as well. So the rule in the FIFO is like first in first out. So the calculated total cost for the sold is 5 multiplied by 100, because we first buy 5 items by 100 each, right? So this would be 5 divided by multiplied by 100, which gave me 500, right? And plus my 2 quantity multiplied by 200, which is the second layer, and that give me 400, and subtotal in here would be 400 plus 500 would be 900, right? Exactly. So when the subtracting the 900 from the sold from 1500 in the total, we get the new inventory value, which would be 600, right? So now this would be 600, And that would be we have to know that we do not have one general item cost for the item master data like in the other valuation method, as the item cost is managed by the each layer right now. So that's how the FIFO manage in the whole system. Now let's talk about the standard cost. So the standard cost valuation method assume constant stock value regardless of the purchase price. So with the standard cost, the unit cost is determined manually when you set up the item, and variance that occur due to the different purchase prices are recorded as a variance account in the general ledger, and the unit cost is not affected on that time. So for example, the unit cost is set up 100, right? I'm talking about the standard right now, right? So unit cost is set up as 100, and we purchase the 5 unit again for 200 each, right? And it does not matter what the purchase price is because the value of each unit is set as the standard cost 100. And the purchase price is for 200 is registered to the variance account, and the inventory value. So then the value of each unit is set to the standard cost of 100, right? And we have 100 inventory now because we buy five with 100 each and 5 with 200 each, and now uh, we still have the standard one as 100, right? And we have the total stock as 10, right? And we have multiplied by the 10 by the standard cost, and that give me 10 multiplied by 100 because that's what we defined in the initially, and that would be my total value of inventory for the standard, right? And the difference in the cost is the second the purchasing transaction between the standard cost of 100 each and the purchase price of 200 each is registered on the variance account, right? And the inventory value after the sales transaction is also set by fixed account 100. So for example, now I'm gonna sell the 7 items multiplied by 100, right? 7 items which would be multiplied by 100 for the total cost, and that would be sold for me on the 700, and we are subtracting that 700 from the inventory value 1000, right? And that leads me into the 300 as the new inventory value, and all the difference between purchasing and selling would be into the general ledger account, as I said. So, and as I said, like it would be when we're using the perpetual inventory into the SAP Business One in here, then you will see then basically whenever you create one document, marketing document or any document, then it really affect the general ledger, right? So for example, if you're using the standard one, right, and you receive an item with 120, but your standard cost is 100, then the standard item cost is 100 and the journal entry will be posted the amount of 120 for the appropriate account depending on the type of transaction we used, and then we have labeled it as an offsetting account, right? Since the standard cost is 100, right, because we already defined in up the standard cost of each unit is 100, then the 100 is posted into the inventory account for the 1 unit purchased, and the rest different the 120 minus 100 is 20, so the difference of 20 is posted into the variance account for that. So no matter what the actual cost of the item was initially, the item value of item in the inventory account is always equal to the standard, which is be 100. And therefore, when the item is issued on the warehouse or the good issue or AR invoice or any document, the cost of goods sold of each item would be 100 for sure when you use the standard cost, right? And that's how it works. So how you can set the standard cost in the set the standard cost. So for setting the standard cost, you can go to the inventory inventory transaction, inventory revaluation, right? And when you select the item, right, for the standard one, then you can set up the new cost in here, right? You can so when you add an item in with the standard cost, then the system will prompt you to update the cost into the item this item revaluation window, right? And it will create a general entry automatically when the inventory exists, and this will give you a clear audit trail for all the changes to the item standard cost, right? And there is also one method of issuing any item without a cost, right? And you can do that from the company detail, from the system initialization, company detail basic. And here you can use the setting of allow stock where a stock release without the item cost, right? So this is only possible for the item set for the FIFO or the average cost valuation, and you have to be consult an accountant to verify the business and the legal requirement before selecting this option as well. That you have to tell your customer, because the stock release without the cost indicator gonna help you to do this. So after that, there is also an inventory audit report, a useful report for the company, which can be found in the inventory report, inventory audit report, right? This report is provides an audit trail for the posted inventory transaction in chart of account, and you can use this report to make the comparison between the accounting view, like the inventory balance account, and the logistic views, like the inventory value displayed by the audit report, and report will explain you the changes into the inventory accounts, right? So the report does not recalculate the item cost, but will display the information, right? So it's not like when you run this report, then it will just recalculate the whole price of each item. And the transaction with non-inventory item or the dropship warehouse is not going to display here, because this is the inventory audit report, so there should be the inventory items, right? And it's only available for the companies using the perpetual inventory system. So you have to have this perpetual inventory checked. That's the only time you can use it. And to create what if scenarios, then you have to use the inventory valuation simulation report, this one, right? So the FIFO layer report by the consumption order is also there. This is this one, and it will provide you the open FIFO layer and their individual values, cumulative values, and the quantity reflect to the current available per layer and not the original quantity for sure. And the layer also list in the order in which they will consumed, and drill down will be help you to see the related transaction by which they are created. So now we already talked a lot about the perpetual inventory. So now let's take another look into the alternative method. So for example, if you're not using the perpetual method, like all the videos that I have created so far is not using any perpetual inventory, right? Previous for the purchase and purchase, sales, and all the other documents. And a non-perpetual inventory system is an inventory management in which the cost of inventories are not maintained, right, on the constant basis. And so that the non-perpetual inventory system like sales, purchasing, inventory, production reflect into the inventory level, do not generate the inventory related monetaries or the general ledger, and they will only affect the inventory values of the company, and the company is not revaluated on every inventory release or receipt, right? So instead of inventory account balance is updated by the manual general entry once in every accounting period, or after a physical inventory counting, and that inventory value can be calculated using the inventory valuation report. So once you run the inventory valuation report at so once you run the inventory valuation report in here, then it will change on the values of each item, and it will generate the journal entry manually into the system, and it will refresh the price of each item. And but this could be also feasible, and this can be doable. And like in my country, like in Germany, we use the non-perpetual inventory system as a default inventory management system, right? So that's the one of the main one of the way, not the main, like let's say, but one of the way to handle the inventory evaluation by doing the manual running of that of the items, selected items, and that's how you can define, and that's how the whole moving average and FIFO and the standard cost is handled in this Happy Business One. So that's all for today, and thank you for watching, and keep safe. Bye.